Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. And you wouldn't know it by looking at the S&P 500 right now, but it's a big week, Scarlett.
Well, we have a big critical meeting between the Chinese and the U.S. officials, so we'll see how that plays out.
And on that note, let's go to the biggest stories right now. I mean, more than $15 trillion global ETF industry. JEPI still remains the largest active ETF, and in just moments, we'll speak to JPMorgan's Hamilton Reiner, who manages the fund.
IBIT has climbed the ranks to become one of the 20 most traded ETFs since its launch a year and a half ago.
And Scarlett will also speak to the man behind that ETF, Robert Mitchnick. He is the head of digital assets over at BlackRock. All of that and more coming up. But first, let's get to Eric Balchunas from Bloomberg Intelligence. He's here with us now. He's looking at the flows. Eric, what do you got?
Katie, Scarlett, thank you. Listen, the past several weeks have been bullish, right? Even in the face of the tariff tantrum, the flows were good. But this week, I got to say, investors are nowhere to be found, or the bulls at least. SGov at the top, that's basically cash, and Bill is cash. And there you got a little value there. And then the ag, I mean, this is pretty boring. Misty is interesting. This is a yield max micro strategy, which, you know, writes these way out of the money call options. Interesting, that's so successful. And TSLL, this is 2X Tesla. This thing went wild during the Elon Trump spat on Twitter, traded. The volume was ridiculous, like 6 billion. So a lot of money coming in, playing the rebound on 2X Tesla there. Let's look at the outflows. And at the top, you're going to see something that has been the top for 2 weeks straight now. IWM, which is small caps. No matter what's going on, it just seems like people have tried to make small caps happen several times, and it just like the flows come and go. More on that in a minute. Some money out of LQD, a little bit out of Soxel, that's 3X semis. There's tech ETF, SPY. So you get the idea. Some money's being taken off the table this week for whatever reason. We'll see if it lasts. Now let's go to small caps. So, you know, I kind of make fun of them sometimes on this show. We've been doing this for 3 years. They just can never get going. To me, they're like a farm league with no star players. Like, seems like large caps have all the big stocks that are surging. And here's a look at the broad market, large cap, and small caps. So small caps, I took it a little bit last year, but then this year, flat. But look at these other ones taken in cash. Negative, flat, negative, flat. So all told negative, yet their large and mid-cap brothers have been taking in tons of cash. So, Katie, I don't know when or if small caps will ever get going. It's an interesting phenomenon.
All right, small caps continuing to catch strays. Eric, thank you. Let's keep the conversation going now with Hamilton Reiner. He is head of U.S. equity derivatives over at JPMorgan Investment Management. Pleased to say he joins us on set. Hamilton, it's great to see you.
Thanks for having me. Appreciate to be here.
So, Hamilton, among other things, you manage JEPI and you manage JEPQ. And Eric has created this phrase that's kind of been picked up broadly, boomer candy. And when we talk about boomer candy, and I promise the setup is going to lead somewhere, we typically talk about the likes of JEPI and JEPQ. And we also talk about buffers in that category. Buffers, of course, use options to create a cushion on the downside, but also cap your upside gains. Whereas my rough understanding of JEPI and JEPQ is that you're using derivatives to create income streams. So what is the pitch to invest in a JEPI, invest in a JEPQ versus buy a buffer strategy, which really they've gained a lot of popularity over the past several years?
Sure. So Eric's boomer candy is about, I would say, more outcome-oriented strategies. And when I think about a buffer strategy, you're thinking about something that's a way to help people get invested, stay invested. You know, equities with guardrails, if you will. But with JEPI and JEPQ, it's about something that's a little more evergreen. Have you ever really heard of somebody that didn't like income or having a strategy that has less volatility and beta or multiple ways of winning? Because in JEPI and JEPQ, you can make money with your dividends, your options premium, and then some of the upside. Notice I mentioned some of the upside. It's not just about income. It's about that three-headed monster of total return. And so with JEPI and JEPQ, we expect our investors to have about 7 to 9% distributable income. With JEPQ, 9 to 11. But if volatility is elevated, it actually is a tailwind to these strategies. So right now, given the elevated level of volatility, because volatility is about uncertainty, and there's a fair amount of uncertainty right now. There always is with what's going on around the world. You know, it's a nice tailwind for these strategies.
So you say higher volatility benefits all your options-oriented strategies, and certainly we're seeing that with JEPI and JEPQ. Is there a difference between good volatility and bad volatility?
So volatility is not a measurement of fear. It's much more of a measurement of uncertainty. And so when volatility is elevated, in strategies like JEPI and JEPQ, we're going to give you two things. One, a little bit more income, and also a little bit more potential upside. So I would say volatility is volatility. Volatility could also be to the upside. What we saw in the second half of April was actually upside volatility as the market ripped after being down up until the end of the first week or so of April. So I think volatility is about uncertainty and a greater range of outcomes. So, but either way, higher volatility is a tailwind to these strategies.
Yeah, I think where they kind of match up with buffers, at least spiritually, is that you're giving up some upside for this, a little bit, depending on how much you want to give up. Buffers, you give up more, but you lock in less downside. Anyway, this idea of selling options, yield max, I just went over MSTY. Can you talk about the difference between you and yield max? Because some of these ETFs have taken your concept of writing call options a little bit out of the money, and now they write them way out of the money. And like MSTY, the yield on this is 136%. Do you consider these competitors, and what's the difference?
So what I would say is, everyone's a competitor in the space, and when you think about those type of strategies, more often than not, they're doing on individual names, and our approach is doing it at the index level because we're active managers. I want to capture all the activeness of our analysts and our portfolio managers. So doing options at the index level means I get to keep all of our alpha and only remove beta. I think what they're doing is intellectually honest. I do. If you had a graph, you could see that in many cases their NAVs go down precipitously because of all that income they're distributing. Our goal is for our NAVs to actually go up over time. Just a different outcome or a different type of candy. I would say it's not a little, it's a lot spicier than what we're doing, Eric.
Interesting, and it's interesting to hear you call these products intellectually honest because, it's easy to find folks out there who would say these products don't need to exist. What they're doing with derivatives, ultimately, these don't lend themselves to products that should be in investors' hands. It sounds like you are not saying that.
So what I say is our flavors, we believe, can fit into many clients' portfolios. There's other flavors that maybe, as I said, are a little spicier, that maybe don't fit into every investor's portfolio. When I think about our strategies and the boomer candy that Eric has alluded to, or called them, it's things like less volatility, less risk, less beta, positive up-down capture, positive risk-adjusted returns, consistent, understandable, explainable income. I think that concept is evergreen when it comes to a client's portfolio. Because portfolio construction has never been harder than it is today as stocks and bonds are doing funky things among each other.
Yeah, well, would JPMorgan ever go that far? Would JPMorgan ever launch a single stock ETF that also has this sort of options income?
I'll never say never, but I can't imagine having a strategy that yields 130%.
There you go.
All right, but never say never. What other parts of the stock market can you apply this premium income model to? You already have it for the S&P 500 with JEPI and the NASDAQ 100 with JEPQ. Are we looking for the Russell 2000 to get its own version, the Mag 7?
So we actually have an offshore ETF that's global. It's called JEPI's international cousin, if you will. But one of the things that is really important to me is, and I know you guys have talked about it, you cannot close an ETF. So an ETF is a phenomenal wrapper. It's tax efficient, it's liquid, it enables me to get securities in. But one of the challenges is that you can't close it. So it's open forever. And so not everything is better in an ETF because there are some things that you don't have unlimited capacity. So for me to think about expanding the JEPI franchise, in many cases, it's not going to be, can we actually give you less volatility, less beta, consistent income, positive up-down capture, positive risk-adjusted returns. It's really going to be, can the options market sustain the ability to do this? And I know you guys have done some work on some strategies that unfortunately outgrew their ability to put on swaps and do things. So I'll never put something into an ETF wrapper if I don't have the ability to potentially have success and deliver those outcomes that clients expect from us.
So I don't think many people know, but you are the fastest growing active manager in the world. 59 billion last year. Then number 2 is 15 billion. So you have made it this is equity only. You have kind of made success, and you've just passed T. Rowe as the 4th biggest in the U.S. What's the secret? What do you have to do? Because a lot of people listening, watching are in the industry, and selling active equity has not been easy.
So I think it all starts with trust, Eric. I mean, first they have to trust JPMorgan, then they have to trust our distribution partners, then the portfolio managers, and then the strategies can deliver upon their expected outcome. That's the first thing. The second thing I would say is that we have an understandable, explainable, repeatable process, right? It always comes back to the 4 Ps: people, process, philosophy, and then performance. And I think that consistency around performance, that consistency around people and process, I think is a lot of it. And we're pretty blessed. Here in the U.S., we have a rock star group of analysts, over $150 million research budget. And I think it's, you used an example before around farm system. I've heard from many folk that, the average active manager, well, that's like saying you can pick anybody in a draft. You actually have to do the work as to who you want to draft in a sports league. It's not just saying I'll take anybody. You do the work to identify those players or those folks that could have skill, and it's the same thing with active. I think people have looked under the covers. They think that we have a chance of adding value and having skill.
Hamilton, as we wrap up this conversation, we started with JEPI and JEPQ, so let's end there. What has surprised you the most about its adoption by investors?
What I would say is the different use cases. I think when we first launched the strategy, we launched the strategies over 5 years ago, and we felt as though it was going to be income, income, income. But what we have seen is about 1/3 of our investors invest in the strategy as a total return strategy. They own it because of that multiple prongs of return, some dividends, some options premium, and then some of the upside. So there's a variety of markets it can work in. In a flat market, you should do okay. In an up market, you're not going to keep up, as Eric said, but you're still going to do quite well. And in a down market, the activeness of the long portfolio plus the options premium should help you capture less of the downside. So I think it's that use case of not just for income, but as a total return strategy, but with less volatility and less beta, that's been my largest surprise.
All right, well, that's a good place to leave it. Hamilton, always a treat to see you. That is Hamilton Reiner of JPMorgan Investment Management. Now, coming up, the new Dan Ives ETF debuted right in the middle of the feud between President Donald Trump and Elon Musk. We'll discuss the fund tracking the bullish Tesla analyst next. This is ETF IQ on Bloomberg. Welcome back to ETF IQ. I'm Katie Greifeld. Time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with portfolio trading. We've talked about it a few times on this show. Basically, portfolio trading, very popular in the credit world. It's been facilitated, these trades, by credit ETFs. But increasingly, you're actually seeing credit trading itself in the underlying markets become more electronic. And now you have those two measures neck and neck so far in 2025. So we'll continue to keep an eye on that. But let's talk about interval funds a little bit. We were having this conversation with Todd Sohn last week about how we're seeing issuers increasingly embrace the interval fund wrapper as the way that they want to offer retail investors exposure to private assets. So far this year, 25 interval funds have launched. That doesn't sound like much, but it is a record for this space, and it is growing. So another thing to take stock of. Let's end, though, with the new ETF that launched this last week, from Dan Ives, the Wedbush analyst. He's known for his bullish stock picks. He's also bullish on Tesla, which has a significant weighting, relatively speaking, in this ETF. And that is a little bit unfortunate, the timing of this launch, because, Scarlett, I'm sure you're well aware that that breakup between President Donald Trump and Elon Musk certainly hit Tesla.
What? The romance is over?
At least for right now. There's speculation about where it goes from here, but you can see it so clearly in Tesla shares when exactly they got into those social media fights.
Yeah, it's pretty fascinating. But, I think Eric and I were talking about this earlier. I tend to believe that they're going to make up, and so this is just a bump in the road. But what I love about this Dan Ives ETF is the ticker, IVES. I mean, I think that really speaks to the moment. If I were to launch an ETF, it'd be FU, obviously.
Oh my gosh.
What would yours be? ED?
Yeah, maybe Eric. I think. Oh no, there's already taken by a stock. But just one quick on thing. Granny, which is the Tom Lee ETF, has 1.2 billion.
Yeah.
This one's at 64 million.
Yeah, he probably saw this and was like, I want some of that.
Yeah.
I will say I was playing around with the terminal because that's my job. And we think about Tesla when it comes to Dan Ives, but if you take a look at his overall universe of coverage, for the stocks that he covers, 51 companies, he has an average return of nearly 37% over the past year, whereas his peer group has a return of about 16%. So again, we think about Tesla when we think about Dan Ives, but he's bullish on a whole host of other tech
Absolutely.
companies.
What does he always say? The party's only at it's going till 4 a.m. and it's only 9 p.m. right now. So in any case, star analysts and star strategists launching their own personal ETFs. That's become the thing.
There you go.
In 2025. All right, still ahead, we're going to drill down into crypto with BlackRock's Robert Mitchnick next. This is ETF IQ on Bloomberg. This is Bloomberg ETF IQ. I'm Scarlett Fu along with Katie Greifeld.
And we're back with today's drill down where we focus on one ETF. Eric, what do you got?
Katie, today we're looking at the one and only IBIT. So I thought I'd start really just right off the bat with the tail of the tape. IBIT is one of about a dozen spot Bitcoin ETFs. We talk about it all the time. They've taken the world by storm. You can see here, IBIT's the biggest at 69. It's actually now 71 billion because Bitcoin went up. Then you've got Fidelity, then GBTC, and then ARK, Grayscale, and the Bitwise. They all custody a Coinbase, which we'll talk about in a minute, except for Fidelity does its own. And then here's the fees. This is really cheap. Up until these came out, this was normally the fee. That's GBTC. But you can see how much cheaper they are. Hedge funds and everything globally was around here. So these have just come in and really cheap, no friction, liquid. And let me show you the next chart, which is IBIT and how fast it's grown. The reason we talk about it so much because there's been nothing like this. It's a phenomenon. This is a chart of the fastest ETFs to 70 billion in history. So previously, GLD was the fastest, right here to 70 billion. It took 1,691 days. IBIT has got there in 341 days. So that's 5 times the speed. Again, just ridiculous numbers here. We'll see where it goes from here. Let's look at the performance, which is one of the reasons it's taken in such money, is because the performance was really good out of the gate. Since they launched, it's up 127%. Now, you know, GLD has had a nice run. It's doubled GLD. That's the US stock market, which has also been doing well. And then there's bonds. So these are the other major asset classes. You could see, Katie, between the benefits you get plus this performance out of the gate, it's no wonder it's been a feeding frenzy.
Eric, thank you. And joining us to talk about this ETF, I'm pleased to say we have Robbie Mitchnick. He is head of digital assets over at BlackRock. Great to have you on set with us.
Yeah, thanks for having me.
So it's almost hard to know where to start when it comes to IBIT because as Eric just walked through in his charts, I mean, the growth has just been stunning. So maybe to set the scene, tell us about where that's coming from. I mean, is it just pent-up demand? We had been waiting so long for a Bitcoin ETF, or what is possibly going on here?
Yeah, well, it's a lot of things coming together. I don't think that you could have a chart that looks like what you just showed, Eric, without a confluence of factors all occurring at the same time. And so it's been a big part, of course, out of the gate was retail and investor demand, and that ran the gamut of small retail investors to ultra high net worth. Now, more recently, we've seen just steady progress of more wealth advisor adoption, more institutional adoption. It's been a mix of people who it's the first time that they've invested in anything in the crypto space. And then on the other hand, you have lots of people who've been invested in Bitcoin for a long time, and they're taking advantage of the ETP wrapper.
When it comes to the adoption by wealth advisors, I'm curious how far along you think we are in that. Are we in the early innings? Are we in the middle innings? Are we, I don't think we're in the 8th or 9th inning, but, where would you put it at?
Very early. I think that what we've seen is a concerted effort by most of the largest firms to progress through their diligence and their research and their approval process. But as you all know, for new ETFs, it's typically a multi-year journey to get any sort of approval. We've seen that fast-tracked by a number of firms. When we talk about fast-tracking, we're talking about quarters, not months. And slowly but surely, you've seen, I think, an acceleration, particularly in the last couple of months, of more notable firms lowering barriers, granting approvals to their advisors to use these, and I think that's obviously set to continue.
So I saw you last in Dubai. We were on this panel together, and you talked about the decoupling. When Bitcoin went down or up, when stocks went down, this is like 6 weeks ago, people were like, oh, that was interesting. And since then, the volatility has actually declined. The 90-day rolling volatility, it's about double gold. It was triple. So it's coming down. Talk about institutional, we'll call them big fish, why this is appealing to them versus what I would call hot sauce or something that's like really like moves around a lot.
Yeah, well, I think there's sort of two competing ideas here that have created a lot of confusion in the market. And the first is that Bitcoin, absolutely on a standalone basis, is a risky asset. There's no question. It's relatively novel technology. Even though the volatility's come down, it's still volatile. But at the same time, its risk and return drivers are markedly different from most of the rest of the assets in a traditional portfolio. And that's important. And so when institutions are looking at this, they're heavily focused on that correlation and whether it's zero or even in some periods negative, because then the portfolio construction case is very compelling to them, right? If it's, which it's at various moments has traded like, even if that's sort of detached from fundamentals, at various moments, it looks more correlated. That's less interesting. So our view is that when you look at this on a long-term fundamental basis as a global, scarce, emerging monetary alternative with a whole different set of risk and return factors, that lower correlation is ultimately what should prevail, but it's certainly something that many of our clients are watching.
Eric, you were saying there's a dozen Bitcoin ETFs out there still?
Yeah, about a dozen.
About a dozen. How long do you think that's going to last? Can the market support a dozen Bitcoin ETFs, or does it need to consolidate?
Well, a lot of them have been, very successul too. Obviously, IBIT has been the leader in the category by a fair margin, but there's been such demand that, it's been exciting. And there's lots of products in the space, and that's a good thing.
And we'll see if they all last. We only have about a minute left with you, less than that. I want to talk about Ethereum a little bit because iShares also has an Ethereum ETF. The ticker there is ETHA. It has almost $4 billion since its July launch, which is also impressive. Compared to IBIT, though, I mean, that kind of blows everything out of the water. But talk to us about who's buying into ETHA, because, okay, I understand institutions getting comfortable with Bitcoin. Ethereum seems like a bigger ask.
Yeah, it is a little bit more of a retail concentrated investor base than what we've seen with IBIT. I think the institutional investment thesis for Bitcoin as this emerging global monetary alternative and a diversifier and a potential hedge, that is resonating quite strongly. When we talk about Ether, there's an exciting story there too, but it's more of a technology innovation story and a bet on blockchain adoption. And that is a much harder case for a lot of institutions to underwrite, especially compared to other sort of technology things they're looking at.
All right, Robbie, great to have some time with you. That is Robbie Mitchnick of BlackRock, and this was ETF IQ.